Okay, good morning. Let's kick this thing off. So although this event is taking place virtually here in Toronto, we will start with our land acknowledgement. So Toronto is in the dish with one spoon territory. The dish with one spoon is a treaty between the Anishinaabe, the Mississaugas, the Haudenosaunee, and that bounds them to share the territory and protect the land. Subsequent Indigenous nations and peoples, Europeans, and all newcomers have been invited into this treaty with a spirit of peace, friendship, and respect. So I'd like to extend a very warm welcome to everyone. Today, we're going to be talking about a very important issue that we all face, ensuring our financial security in our retirement years. Hello, my name is Bruce Choi. I'm the Managing Director of Research at the Global Risk Institute, and I'll be the host for today. So financial security in retirement is a growing concern for many Canadians. A recent National Institute on Aging survey showed that 77% of older adults are worried about their financial well-being. Now, with retirement expected to last several decades, combined with unpredictable financial markets and changing personal circumstances, older Canadians face a tremendous challenge of turning their accumulated savings into income that will last the rest of their lives. Now, an emerging solution is dynamic pension pools. It could give Canadians access to affordable retirement income for life. And describing what these dynamic pension pools are and how they work, and today we'll be describing these dynamic pension pools and how they work. Dr. Bonnie Jean McDonald, Director of Financial Security Research at the National Institute on Aging, and Barbara Sanders, Associate Professor of Actuarial Science at Simon Fraser University. Now, this research has been sponsored by two of Canada's leading think tanks, the National Institute of Aging and the Global Risk Institute. The National Institute on Aging is a public policy and research centre based at Ryerson University here in Toronto. The Institute is dedicated to enhancing the successful aging across one's life, and the Global Risk Institute provides thought leadership in risk management for Canada's financial industry, bring together leaders from industry, academia, and government. Over to you, Bonnie Jean and Barbara.
Thank you so much, Bruce. We'll just wait for the slides to get up. But I'd like to say that we are really just so truly delighted to be speaking at our first NIA and GRI webinar today, and to really be sharing with you some of the challenges that we see facing the Canadian retirement income system, and then to discuss what we believe is a really important solution to help bridge that gap. Excuse me for a second. So this presentation covers the material in our paper that was just released last week by the NIA and the GRI. And to begin, then, by definition, retirement financial security really does mean being able to maintain your standard of living throughout retirement. But we can really begin to see the gaps and the challenges that Canadians are going to face in retirement by really looking at the snapshot of the Canadian retirement income system. So between old age security, guaranteed income supplement, and the CPP, there'll be about $20,000 of annual income that individuals will get from these government sources. And this is really going to provide them that inflation index baseline. However, everything else should be coming from private savings and from workplace pension plans. But 80% of Canadians in the private sector, they are not in a workplace pension plan. And this has really created a big gap in the Canadian retirement income system. So for the past 4 decades, public policy makers, academics, and the industry practitioners, they have just very strongly been advocating for Canadians to overcome their retirement security hurdles by saving more. And in fact, it's really been the overarching theme, and I think we all know this, who's been in this industry, that really Canadians need to save more for retirement. It's been said for a very long time, whether it's in their DC pension plans, their group RSPs, their individual RSPs, or somewhere else. Now, a challenge with all of this is that, of course, when it comes to retirement income, RSPs and DC accounts, they really do lack that one important element. They don't actually provide pensions. They don't actually provide that secure lifelong income that will protect a person's retirement financial security. Look at it from the individual's perspective. Even if Canadians are able to save adequately, we need to appreciate for them to manage and draw down all this savings over retirement. This is not only a difficult task, it's pretty much an impossible task. Retirees basically need to manage a pot of money that's going to grow in an unknown way to pay for unknown expenses. And these costs will grow in an unknown way and change because of inflation. And again, this is over this kind of unknown time horizon of retirement that could last anywhere from a few days to a few decades. We just don't know how long we're going to live. So this is actually an impossible task. And the sad irony is that if someone does run out, it could very well be at the time that they need the money the very most at a more vulnerable time of life. We have to appreciate that running out of money for a 90-year-old, it's not like a 65-year-old. 90-year-olds, they can't manage a dramatic reduction in their spending. And that's because healthcare costs become fixed. They cannot be postponed. And 9-year-olds usually don't have the option to make up shortfalls by getting a loan or going back to work. So RSPs, DC accounts, these are really just more like pots of money. But what Canadians really need now is an affordable income that lasts for life. Otherwise, they have the potential to run out of money when they actually do need it the most. So Canadians are increasingly facing this very complex challenge of turning their savings into lifetime retirement income. And for these reasons, we know from our surveys that retiring Canadians are now more worried than ever that their savings won't sustain them in retirement. And these fears, as I said, are absolutely legitimate. Financial markets, inflation, health expenses are some of just the big unknowns that retirees are going to face over 10, 20, 30, and even 40 years. What the Canadian retirement income system needs most of all now is an affordable pension income option that will last for life. Otherwise, as I already said, that people could run out of money when they need it the most. The good news is there's actually a great option that would give Canadians a more financially secure retirement. And those are dynamic pensions. So what dynamic pensions do is that they actually will enable retiring Canadians to pool their money together. And in effect, what they're doing is they're creating almost like a cooperative pension, in that by keeping their money in a pension plan, they're able to share their longevity risk, and they can also get higher expected returns while also ensuring that they have a stable source of pension income for life.
Yeah, so Canadians at the moment who want to convert their retirement savings to income have just two broad options. They can buy a traditional annuity, or they could move their funds to a RIF or a LIF and then manage the investment and the drawdown of those savings themselves. Now, traditional annuities provide a guaranteed stream of income, and they do so by essentially doing three things. They pool many annuitants together, so they share longevity risk. They make conservative investments, and they hold significant risk capital to honor those guarantees. On the other hand, a RIF or LIF allows the fund to be invested less conservatively, so the retiree can actually take advantage of the equity risk premium, which is the additional return an investor is expected to get in exchange for taking on risk. Now, RIFs also give retirees more flexibility about how they could access their savings than annuities do. But with a RIF, there is no protection from longevity risk. A retiree, as Vanajin said, could actually potentially outlive their savings. So a dynamic pension pool combines some of the features of these existing options. And like traditional annuities, they provide a lifetime income stream, and they do it efficiently by harnessing the power of longevity pooling. But unlike traditional annuities, they don't provide a guaranteed income. So instead, the pension amount is adjusted dynamically, hence the name, to reflect the investment and mortality experience of the group. And because the income stream is not guaranteed, a DP pool can take more risk than a traditional annuity issuer could, and that gives the DP pool access to the equity risk premium. So to summarize the advantages, the DP pools protect retirees from outliving their savings, which is a significant risk, especially after age 75, but do so without forcing them into a conservative asset mix. They also give retirees access to professional investment management and can do so at a lower cost than what might be available in the individual market. And DP pools are also potentially attractive to employers and other providers because from their perspective, there is no added risk. Now, one thing to emphasize is that longevity pooling, of course, works by taking the assets that are left behind by those who die sooner than expected and using it to pay pensions to those who live longer than expected lives. And this is always at the heart of any effective lifetime income provision. So DP pools are no exception to that. However, it doesn't mean that there cannot be death benefits. a DP pool can, in fact, offer joint and survivor pensions, guarantee periods, or even a refund of the initial capital that was paid into the pool, net of any benefits received, of course. And these are very powerful options from a behavioral perspective, helping retirees get over the fear of maybe not getting enough of the DP pool. So this sounds like a great idea in theory, but how do we know DP pools would work in practice? Well, we know they work because the UBC faculty pension plan has been successfully running one since 1967. And many of you probably have heard of their version, which is called a variable payment life annuity, or VPLA. We prefer the name dynamic pension pool. In fact, the origins of the UBC dynamic pension pool lie with an organization called TIAA, the Teachers Insurance and Annuity Association of America. Now, TIAA is a major provider of retirement products in the education and nonprofit sectors in the US. And in 1952, so quite some time ago, they introduced a groundbreaking product called what they called the College Retirement Equities Fund, or CREF. And this gave retirees access to equity markets while still providing lifetime income. So CREF essentially operated or was set up as a DP pool, having no guarantees and holding no reserves, just simply adjusting the pensions each year. And CREF has been operating for over 70 years now. It's still running, so we know that there's successful implementation. Now, more recently, UBC's success story inspired QSuper, one of the oldest and largest Australian DC plans, to introduce a lifetime pension option. And they took the basic DNA of UBC's product, modernized it by taking into account all the latest research on behavioral finance, and then adapted it to the Australian market. And since this project was launched back in March 2021, it has actually won recognition from around the world, including several awards for innovation. So, here we are in Canada having a well-running prototype at UBC that's gaining international attention and praise. And yet for the last 20 odd years, domestic DC plans were not allowed to set up dynamic pension pools because there was a legislative obstacle.
So as Barbara explained, this lack of an acceptable, readily available option to convert your retirement savings into an affordable monthly lifetime income, it's really created this dangerous disconnect in the Canadian retirement income system. And there is widespread concern that this is going to lead to a financially insecure large proportion of the elderly population. So about 5 years ago, I took this on as an important research project for the reasons that Barbara explained. And the motivation for that research was laid out in a 2018 research paper that I wrote for CD Howe. But the most important aspect of this concept was the interest and support that it held in industry and by pension plans across Canada. So much so that in 2018 with Keith Ambasher, we at the NIA took this idea, spearheaded an advocacy campaign, and created possibly the largest coalition of pension plan stakeholders in Canada, including the CIA, PIAC, CLHIA, ACPM, CARC, GRI, and others. And together we wrote this letter to Canada's Minister of Finance. And in this letter, we explained the value of allowing retirees to pool their money together. And much to our amazement, it was actually successful. It directly led to an announcement in the 2019 federal budget that the required legislative changes were made to allow these two new annuity options, which were called VPLAs, which we're calling now dynamic pensions, and ALDAs, to basically become a reality. Clearly, this is a very big deal, and it's going to include changes to both the Canadian income tax as well as to pension legislation. So this really was remarkable. Now, throughout this process, there's been a lot of interest by media. So anyone who's interested in knowing about this story, they could go to those sources. And then not long ago, it was really the 2021 budget that pushed this all through, and here we are today. So this is a great news story. The federal government has enacted amendments to the Income Tax Act regulation that would allow sponsored of DC plans and of pooled retirement pension plans, PRPPs, providers to basically set up DP pools and make them available to members within those plans. It was without a doubt a fantastic step in the right direction. But what we found in our research over the last 2 years is that DC plan assets are just the tip of the decumulation iceberg. There is $1.5 trillion in registered savings account nationwide, like DC Plan, RSP, RIFs, And DC plans only represent 10% of the $1.5 trillion of registered individual savings. And DC plans cover less than 7% of working Canadians. And unfortunately, we also found in our research that the PRPP implementation is very unlikely to fill the gap. There are serious obstacles to access in the current PRPP marketplace, and these obstacles are really unlikely to disappear without further regulatory intervention. So if we put this all together, the result is simply that in the absence of changes to the regulatory framework, dynamic pensions will likely be out of reach for the vast majority of Canadians. So we're not achieving our goal. And we believe that to effectively address the decumulation disconnect, affordable lifetime pension income needs to be broadly available to all retiring Canadians from a variety of providers. So really the purpose of our report that was released last week is to outline the key features of a framework that can bridge this $1.5 trillion decumulation gap and support DP pools across the entire Canadian retirement income system.
So in our report, we asked the question, what would be the conditions under which DP pools could reach their maximum potential? That is, benefit the biggest number of people in the shortest possible time, while of course still maintaining quality and value for members. And we identified 6 criteria for what we would consider successful implementation. Number 1, we wanted to make sure that DP pools could accept any type of registered assets, so money from DC plans, group RSPs, individual RSPs, even RIPs, you name it. Number 2, we wanted to make sure that access to DP pools would be available to all Canadians. This was really important. Our third criterion was about quality through size. We felt that a DP pool should be large enough to provide meaningful longevity pooling, and a 10-person pool just doesn't achieve that. Our fourth criterion was also about quality, but through governance. So we wanted DP pools providers to have fiduciary duty towards the members of the pool, and we wanted the pool to operate transparently with appropriate controls and oversight. Our fifth criterion focused more on supply, recognizing that a successful implementation would only be possible if there were providers who were willing and able to invest in the necessary systems, the expertise, but also in the marketing and distribution needed to bring DP pools to scale. And here we spent a fair bit of time thinking about what kinds of entities would make suitable DP pool providers. We first looked at big financial institutions, the life insurers, the banks, but we also considered other types of entities. So industry associations, unions, fraternal societies, even provincial agencies. And we concluded that successful implementation would need a variety of these entities. We also found that certain nonprofit providers would be a natural fit for DP pools, largely because of the trust that exists between these entities and their membership, which is really critical for this type of long-term irrevocable pooling arrangement. And our sixth criterion was clear, simple, and harmonized regulation for DP pools. That's because longevity pooling is most effective when you have a lot of members. So it would make sense to operate cross-provincial pools, and that requires consistent rules across the various jurisdictions. So then we looked at different possible implementation options and evaluated them against these 6 criteria. We started with the 2 implementation options that Bonnie G mentions that were considered in the recent round of changes to the Income Tax Act. And so that's offering dynamic pension pools inside DC plans or inside PRPPs. And we identified a number of obstacles with these. I'm just going to touch on a couple of them. You can read the report for more detail on the others, but the biggest one was universal member eligibility. How do we make these available to all Canadians? If you could only have a DP pool inside a defined contribution plan, this universal access would be difficult to achieve. Only, as Bonnie Jean said, a small proportions of Canadians work for an employer that has a registered DC plan. And under the current pension rules, a plan participants must have or had employment link, I should say, to the sponsor of that plan. So if you want universal access, then this requirement of the employment link would have to be removed. Looking at PRPPs, access is also not universal. First of all, these are not even available in every province. Secondly, to join a PRPP, you either have to be self-employed or again, work for an employer who sponsors one. And that means most people still don't have access. So universal member eligibility is possibly the biggest problem here, but you can see on this chart, it's definitely not the only one. So looking at these 2 options, we were not entirely confident that the current direction is going to lead a big surge in the provision of dynamic pensions without some further changes. The next option we looked at was a securities-based implementation. I saw someone in the chat has asked, how does this relate to Purpose's longevity pension fund? Well, some of you might know, we now have a mutual fund with longevity pooling in it available in Canada, and retirees can then access longevity pooling by investing in this mutual fund. And this was, to us, a very interesting development. We wanted to know how well it could satisfy our 6 criteria. Well, this implementation option definitely has some advantages. It's great in terms of universal treatment of registered assets, and the member eligibility is truly universal, like anybody can buy a mutual fund. But at the same time, there were some big obstacles, and the most significant being the lack of effective protection from longevity risk at very advanced ages. So in a nutshell, the classic mutual fund structure forces you to have what we call cohort-based pooling. So only members in the same age cohort are sharing the longevity risk. But unfortunately, as this cohort ages, there simply aren't enough members left at those advanced ages to provide meaningful protection from this risk. Now, it's been shown in the literature that a DP pool that combines multiple cohorts can actually provide more protection and produce more stable income at those advanced ages, but we've got yet to figure out how to do that through the mutual fund or securities route. The fourth option we put forward was implementation through what we call standalone DP pools. These would be new containers rooted in the pension paradigm that by design could meet all 6 of our criteria. They would be large decumulation only pools that could operate across provinces, available for anyone to join and accept all kinds of registered money. And to us, this seemed like the cleanest way to proceed and the one that could ensure really seamless integration with the rest of the pension system. But no matter which implementation option or options are pursued, the regulatory framework for DP pools has to work for everyone, and that includes members, employers, and other providers. For members, obviously, the quality and the value needs to be there, both in the short term and the long term, and the framework has to support easy access for all Canadians. For employers, there should be flexibility to choose the setup that best suits their needs. And for other providers, the framework must be compatible with the business case for actually introducing DP pools.
So again, we're just so excited that our report was released last week. It was published again with the NIA and the Global Risk Institute. It's been a very, very long time in the making. It's free to download. So please, in the chat, there is a link to that report. Unfortunately, since it's been released last week, the interest by the industry and the media has been incredible. And in fact, just yesterday, a colleague told me that they had a colleague who's basically in conferences in the United States, and they're actually hearing about the report in US conferences. So that's actually means this is really going far, which is great. So I think what we should say is we should be really proud of the progress that we've made in Canada. We are ahead of most countries, but our take-home message is that we're just not done yet. The report is focused on how we can remove these kind of unnecessary obstacles and clear the path for what we believe, and the entire industry really by consensus believes is a highly promising solution that could bring millions of retiring Canadians greater financial independence and peace of mind. And I'd like to also mention that there are 4 authors on this report, but please note that this has, without a doubt, been a combined effort of thought leaders across Canada and beyond. It was really built on dozens and dozens of interviews and case studies, and this is really where we came to the recommendations that we're giving. We received an incredible amount of insight and help, and that's because at the NIA, we really do strive very hard to bring together insights and expertise in all the work that we do, and that's simply because coming up with solutions to a problem of this magnitude, which is basically a disconnect in our Canadian retirement income system, it does demand the best from across academia, government, and industry. And there are just so many people who have meaningfully contributed to this research. And I would like to take this opportunity on behalf of myself and my co-authors to really thank you all so much. And again, I'll also say that if there's anyone out there who's interested in becoming a part of this coordinated effort, please do reach out. In closing, the global consensus, and this is built on academic studies and practical examples, and really universal agreement is that DP pools are an effective, inclusive, and sustainable solution to this decumulation challenge that we're seeing in Canada and in countries around the world. With the legislative changes identified in our report, all Canadians could gain access to DP pools, which is the missing link in the retirement income system today. So thank you very much. And I think I'll turn it over to Bruce next.
So thank you, Bonnie Jean and Barbara. At this point, I'll actually invite your two co-authors to the virtual stage. So introducing Laura Strachan, who's the consulting actuary with ECLO Pension and Group Actuarial Practices, and Mitch Fraser, partner and chair of the Pensions and Employment Practice at Tories and the Chancellor of Ontario Tech University. So welcome, guys. So before I dive into a couple of the questions that we've got from the audience, I want to start off myself with some of the nomenclature. We've got variable payout life annuities, dynamic pensions, which you guys have got now, and even the classical tontines. What's the difference, and why was dynamic pensions chosen? I'm not sure who would answer that one.
Maybe I'll start with just addressing what a tontine is. Some people might have heard about it. So tontines have been around for almost, I think, 400 years. They are essentially a form of collective investment and a way of generating lifetime income. So what happened 400 years ago is a group of people would get together, they would pool their money together, and then the survivors in the pool, whoever was still alive at each year, would then receive income from that pool. It would generally be the dividends. And so this is a way of providing lifetime income, but also sharing in the investments collectively. They've been operated, as I said, for almost 400 years. At some point, they've gotten a negative, a bad rap, essentially, and not really with any real foundation. At some point in popular literature, there was a variation where the pool, whatever was left to the last survivor, would actually be able to cash out the pool, and that was given incentive, basically moral hazard for that individual. That's not how these pools actually work in practice. And also at the turn of the last century, so around in the early 1900s, there were a number of failures of these types of products and a lot of a number of fraud cases. But that way, again, has nothing to do with the design of the product. It was actually just lack of controls by the insurance companies that were operating these in the US. So these are actually still legal in many jurisdictions. People tend to think that they're not legal. They are. And actually, there's modern tontines now that have taken into account, all the behavioral finance considerations, but also how to actually make the longevity pooling the best possible thing available with modern technology. So that's it is a dynamic pension pool is a form of a tontine. We just don't like to use that name because that name actually has just some very negative connotations in the public's eyes. And this is a voluntary product, so best to give it a name that is actually attractive.
Sure. We'll have to blame those crime authors.
And I'll just give a bit of background as to how we came up with the dynamic pension name itself. As we saw in the presentation, the VPLA name actually comes from originally UBC's faculty pension plan. But since they started using that name, there's been other names that have come about that can be easily confused with the VPLA name. And when we started our research, we undertook a lot of interviews. And on several occasions, we ended up talking really across purposes with the interviewees because they thought we were talking about variable annuities, for example, rather than VPLAs. And a variable annuity is a different type of financial product, totally different to a VPLA. And, in addition, we now have variable benefits in Canada where, payouts are made directly from a DC plan after retirement. So after seeing this confusion firsthand that the VPLA name could cause, and given that it's a financial product that people will need to voluntarily elect at retirement, we felt very strongly that a new name was needed. And we wanted it to articulate, all the benefits, how they work so that they fluctuate up and down, hence the name variable, and also the collective nature of the vehicle. So we came up with the term pool. And importantly, we really wanted to move away from the term life annuity because typically, we would use that to signify a guaranteed benefit from an insurer, and a VPLA, as we saw in the presentation, is not a guaranteed benefit, and we were concerned it would cause confusion for consumers. So we came up with dynamic pension, and we're very excited today and to hopefully promote the adoption of this new name.
Oh, fantastic.
And the term I'll just mention too, so the term dynamic is actually has a technical meaning. It means a financial process or a mathematical process that does adapt to new circumstances. So to us, that really reflected what's happening here. You have a group of people, their pensions basically being adjusted year after year based on the emerging circumstances. And I'll also mention that, we have done a couple of presentations on this. And I think the person I was most worried about was, they said, dynamic pensions. I like the sound of that. So to me, that was a success that, the people who are advocates for tontines, they actually all really support this new name. They, it's time for a new name that's not only more attractive, but also it's more technically accurate to what it is actually representing.
Okay, so let's move into the mechanics of it. We've got some questions from the audience. Tina's asking who manages the investments, and Andrea was also wondering as in who are some of those providers. Particularly when Barbara, you mentioned something about not for profits involved in there.
Yeah, maybe
So
I'll
would like to take the mechanics.
I'll answer the not-for-profit question, if that's okay. So I didn't mean any not-for-profit, as in the Canadian Cancer Foundation. What I meant is an organization that brings together a membership, a large enough membership, who have some sort of reason to stick together. Okay, or an organization that already administers large amounts of financial capital or large financial streams of payment, but could also get into this line of business. So what I meant was a fraternal association or an industry association that might already be maybe already sponsoring a multi-employer pension plan, especially a defined contribution multi-employer pension plan, a provincial agency. So some of you may have already heard of the Saskatchewan Pension Plan that is run by an arm's length agency of the Saskatchewan government. That agency provides a pension and a lifetime income already. There's no reason why it couldn't, or something like it couldn't also provide a dynamic pension pool either within that province or more broadly. But the reason for the nonprofit was, and it's explained a little bit more in our report, that many of the for-profit providers have already attachments to various parts of the retirement income system, and it's not clear how this particular product would fit into their business plans. There's also some questions around, well, you mentioned governance as being an issue within not-for-profits, but from a governance of the pension stream and the governance of this pool, there would be questions about potential conflicts of interest if the provider was also, trying to make profit, and it was a stream of profit for shareholders, right? So profit for member versus profit for shareholder entities would have a difference. And our position was that there should be, we are encouraging, we believe that life insurers and banks and those who are currently already in this space, in the retirement income space, have great capacity to offer this. They already have the systems, they have many of the expertise, and we think they should go ahead. But there's also some disincentives for some of these organizations. We wanted to make sure there's adequate competition, maybe by some of these new players, to really foster broad adoption and really that investment that is needed at this early stage.
Yeah, thanks for that clarification. So Mitch, you're a leader that straddles a couple of different spheres. So I'm going to fire this question over to you. What are the next steps? How do we make dynamic pension pools a reality here in Canada in the way it's been envisioned in the report?
Yeah, I mean, actually, it's in the actual chat. We heard from our friend Michael Peters, our great friend who's a regulator out in BC, and there are a number of ways. We need the federal government to jump in to assist. Michael is suggesting out in BC that this can be simply done by regulation. We need all of you on this video call to speak to your network and contacts. You're all people who obviously have an interest in this industry. There's lots of opportunities. I think we'd start though with various governments and regulators to try to implement the 6 points that Barbara had mentioned earlier. In our report, it's we call it research to reality. In this phase, I like to say we've been bringing the camel to water, and now we need the camel to proverbial come out and drink. One of the things Barbara was touching on earlier was, who is eligible to do this? We need to be, we need more people to step up, and part of this is coverage. So, when Barbara was mentioning the large list, she's mentioning not-for-profits. There's also unions. There's also, asset managers out there. There's lots of different opportunities. So, next steps, for us is, we've, as Bonnie Jean mentioned, what an incredible collective effort. If you looked at all the people who, contributed, to this over the last, several years, next steps is to, really start to, engage the people who can make the meaningful change, because the comparative chart that Barbara was showing, each of the existing options, has gaps. We need to close those gaps, and there are a number of ways to obviously do that.
So I'll continue on with you, Mitch. There's questions in the chat about, are there any particular provinces that are more ahead than the others in considering legislation, and on a federal level, just the tax treatment, whether you see any hurdles there?
Yeah, I mean, it's interesting because I think, the number 3 in Barbara's earlier list, we saw, and Bonnie Jean talked about this as well, the 2019 budget managers, help us. They set, the minimum, threshold at 10, but we need more from the federal government because we need larger. The idea, we need larger pools. We need larger amount of involvement to make this work. There was, I remember, several years ago when, PRPPs came out and everyone thought that would sort of be the panacea, and there wasn't, enough of a take up to really, change, or expand retirement savings. I mean, the biggest part of this type of research is, how do you get people who aren't saving to save? I mean, it's the whole essence of the work that you do at Global Risk and that what we do at the NIA, is to make sure that, people have strategic planning for retirement. And one of the ways to do that is to create, more options for them. And this particular option here, has been in the works, as if for quite some time. I mean, one of the things that Barbara mentioned, was obviously UBC's, VPLA, and then the excellent work that this was leveraged off of to do the, the Q Super's lifetime pension in Australia. So, I'm not going to, single out, one province over another. I just say that, we've got, people, I believe, who are supportive of this in every province. That's single out Michael. We need more Michael Peters out there who, understand how important it is, for people to start saving at an earlier age and to expand coverage, and that by doing small things, you can make big changes.
So, Mitch, you highlight one of the key risks, and I might fire this question over to Bonnie Jean with this one. As in, for this to really work, you need to have a pool that's sufficiently large and sufficiently diverse. So, what can insurers, plan sponsors do to maintain a high participation rate when this is not mandatory? And Tina's asked I guess a similar question on the chat, and you're asking to build trust with this financial institution who is not still going to guarantee something to you. So how are we going to overcome consumer behavior for this?
Yeah, what's really great about this project is that we did build it out of these case studies, and through that we did have many talks with Q Super. And because they have such a big plan and so much capacity and resources, before they launched their award-winning dynamic pool, they basically did all these interviews and research with their own massive membership of hundreds of thousands of people to understand what would be the mental barriers to prevent people from doing something like this. And really where they came to is that it really comes down to trust. They said that people actually are not so much concerned about running out of their money, because people just, and we know this through behavioral economics, people can't think long-term like that. None of us can. We can't think 30 years in our future. But what we can think about is the fact is, I don't know what's going to happen, and therefore I don't want to spend my money. So that's what we see in the data, is that it's more about people going to retirement with this sense of fear and then not feeling comfortable even to enjoy their wealth in their retirement. And I think that's the saddest part, is because we now have people who have saved so much money and they've done their very best and they're now in retirement, and they just don't have that kind of vehicle that will actually give them the peace of mind to spend their money. So anyway, basically what Q Super did then was to help to give people that feeling of safety and of trust. So a huge element that we found in the case studies as well is that now on the industry side, there's something we call the annuity puzzle. And that's the fact that economists believe that everybody should buy an annuity in retirement. It's the most efficient way to turn your savings into income. But in reality, less than 1% of people do it. So I actually did a literature review a number of years ago, and I actually read 150 academic papers on this topic. So it's a huge area of research, and there's no answers. I think really where we've landed on that, the answer is really about trust. Because what we found in the case studies is that those DC plans and DB plans effectively, who actually offer in-plan annuity options, the people trust the provider, they feel like they're working in their best interest. The take-up rates were humongous. Like we're talking 30, 40, 50% compared to the 1% in industry. So I think one key message in making this viable and actually having take-up is to bridge these trust elements, which is really, to me, the key to making this have high widespread adoption. Okay.
So I've got a question from Peter Forsyth, and I might fire this either to Laura or Barbara. It's talking about, I guess, the fairness of the whole thing. As in, how do you realize that actuarial or financial fairness when you're designing this dynamic pension option? Laura?
I can jump in to start. So that definitely is something that will need to be considered, and it will probably be something that will need further research. It's not something at this stage. We're looking at the higher level kind of framework for providing DP pools, but it will also depend on the circumstances in which a plan might be providing benefits. So for example, if you are looking at UBC's plan, that's a fairly homogenous group. And so issues arising from unfairness there are going to be less likely to appear perhaps in plans that are being provided by industry associations or a plan like UBC's. It is something that Q Super clearly considered and felt, and made their decision. So again, they did a lot of research to come up with that decision, so that will be needed. It's important to note as well, though, under current pension regulation, you're not permitted to provide a benefit that's different based on gender. So there's also issues to consider there. And if you're not distinguishing between gender from a pension plan, then it might not be appropriate to make other distinguishing features as well. And at the end of the day, some of this fairness, it's something we accept currently, in our DB plans. People save for life, have pensions saved for them by their employers, that we accept as a reality, that the benefits they get from that insurance that helps them overcome that huge individual risk of the chances that you live far longer than you expected, you're still getting a lot of benefits. At the end of the day, not necessarily everything might be fair, but further research will of course be needed.
Maybe I'm just going to add a couple of words here, because there was also another question that I see in the Q&A about, maybe the structure that's adopted by the UBC VPLA and that has also been adopted by Q Super is not perfectly actuarially fair, and that's a valid concern or a valid observation. The level of actuarial precision with which you allocate the mortality credits to the survivors in each cohort is variable. Like there's many different ways to do that. But I would just say two things. One is, as Laura had mentioned, there's already huge differences between men and women in terms of mortality, and if we're not allowed by legislation to differentiate on that, pretty much everything else is going to be minimal in relation to that. Secondly, just a reminder that there's a trade-off here between accuracy or perfect precision and simplicity and ability to explain to members, right, how the the adjustments actually work. People must understand how their pension is going to be adjusted. And the more actually precise we get, the more we lose that simplicity of the pool. It is extremely simple and also quite robust to the pool to say everybody's going to get the same adjustment no matter what, right, each year. And so that's really powerful. And then finally, just noting that the mortality adjustments are really quite small in a large enough pool. They're really quite small compared to the investment adjustments each year. The investments themselves, because you're investing in risky assets, are going to spin off way more in terms of the fluctuations than the tiny little adjustments that may be needed on the basis of mortality. So yes, in Canada, we're going with the simpler approach, as QSuper did. And we're advocating for that. There are many other possible approaches, and around the world, and not everybody's embracing this. Certainly, modern tontines try to make some of the more finer adjustments as well. There's many possible implementations. We could probably talk a whole day about all the different ways, and we hope to put out another paper about these more granular issues. But the key point today, I think, is that we need to make sure that these things exist in the first place, and that they are supported by the legislative framework. And that's what our report is really about. It's not getting into the weeds on the implementation, but really just saying, how can we make sure that these things actually would take off if they were offered?
And Barbara, you seem to have a supporter there with Michael Peters putting in the chat an old adage, don't let the perfect stand in the way of good. So a question from Jeffrey. He was wondering whether these dynamic pension pools are reversible or transferable in your design.
Can start off with that one. There is the possibility that will be potentially a choice, for the plan design itself. There is in the securities route currently, that is an aspect feature that is something also that QSuper found to be, important to them. And so they offer return of initial premium less benefits paid to date. And that is a bit of an effective guarantee. So it may need to involve some insurance solutions, but it would give people comfort that they would get at least their value for money. As for transferable, that's more difficult. I know on the securities route that is it is possible within a certain time period, but that certainly wouldn't be the intention that you would be going out there to move between these funds. It's more as to give people comfort that they'll get value for their money if they were to die early, for example.
Mm-hmm. Actually, we'll continue on with some of the design elements. So Laura, as in, how would you see some of those design features to kind of reduce the selection bias that you may well get with a dynamic pension scheme?
Well, the first one will be exactly what I just described. Having that return of premium would really give more people comfort and make it more attractive to a variety of people. Another one would be to cap the money that could be brought into a DP pool by any one individual. So that would help ensure that there wouldn't be one individual or say a group of individuals that ultimately live longer than others in the group, that they wouldn't have a much higher share of the weighting of the pool of assets than others. And then, of course, just because it would remain to be seen, how much actual bias you would see. Just because people think that they might have a high life expectancy doesn't mean that everybody's a good judge of that, and it may not turn out to be the case in reality. And as I mentioned earlier, just because I might not have as high a chance of living to 95 as you do doesn't mean that I still wouldn't find the benefits from a DP pool that address my individual financial risk of the chance that I still could live to 95 might be just too big for me to bear alone, and I would still derive huge benefits from the DP pool.
Yeah. So, Barbara, I know we addressed this in the presentation, but it's come up a couple of times in the audience chat. Could you once again describe that difference between what you're offering here and what purpose is providing?
So what we are describing as dynamic pension pools is a really broad concept, and there's many different ways of implementing it. So we're just saying this broad concept of a dynamic pension pool brings together people, retirees, who want to convert a pot of money into income over the rest of their lives. And they do so by sharing longevity risk. So anything that can do that and do that without a guarantee attached to how much income they actually get to draw. So anything that can do that, I would say satisfies the requirements of being called a dynamic pension pool. And the Purpose Longevity Fund is basically one possible implementation of that idea. There are, as I said, there are 4 possible generic implementations that we could think of. There's probably many others, but that's one possible implementation. And that specific implementation has the additional constraint, if you will, that the pooling only works within one cohort. So it's only a bunch of 65-year-olds that are sharing the longevity risk. They're not sharing it with who are currently 66-year-olds. All the 66-year-olds are in a separate mutual fund, if you will, or a separate stream of that same mutual fund, and they're only sharing that. And then the 80-year-olds are only sharing with other 80-year-olds, right? So there's still that pooling happening, but there isn't this multi-cohort pooling that can happen in different implementations. So that's one difference. Of course, like I said, if you look in our report, we sort of address each of our 6 criteria of how each of these different implementations stacks up against these criteria. We're not saying, go with one or go with the other. We're saying no matter which one you go with, there are obstacles for this to take off and to satisfy those 6 criteria. And we're drawing attention to that, and we're urging people to, whichever implementation option they prefer, to work on fixing those specific obstacles.
Okay. Now the other questions we got coming around is dare I say, some of them are quite mechanical here. So I'm not sure who is best to respond to them. But things such as would there be an option to last to die for a couple, or is there things such as minimum pay-ins as such as part of those design features? So maybe back to Laura on that one, since we talked about design a moment ago.
So we had a couple ones there. So as we mentioned in the presentation, there you could have options for death benefits very similar to what we see with traditional annuities, and that would be up to the plan to select and design and price those appropriately within the plan. And then the second part, was there sort of about minimum? So what was this? A
minimum amount to be transferred in. Whether that would create any moral hazards, I suppose, or you mentioned about a cap that would be essential to make sure there was no overweighting, but whether a minimum is also another tool that could be used. Yeah,
there might be, similar to the small pensions, in DB plans at the moment, it might, for practical reasons, having a minimum might be useful in terms of, the administration costs for providing such a small benefit might not be practical. So from that sense, that could be useful. Whether for other reasons, not sure, that would have to be considered, the reasoning behind that. But I would say more just on the very small side might be the most practical that you would want to have.
Okay. There would be a legal restriction against that. It would be a plan design feature. So
yeah. And also it could, as was mentioned in the presentation, so these could have any of the same types of benefits as in a DB pension. So the joint and survivor, Laura also mentioned the money back, etc. So there's all these types of features that could just be costed in by the actuary doing these numbers. But the point is kind of, as Barbara keeps saying, and everyone says, is that really it's going to be so exciting to talk about how to best fine tune these machines.
Yep.
But we just need to make sure that the cars are allowed on the road first of all. So.
And dare I say that there's a very active chat at the moment talking about these fine-tuning mechanics, and what I would encourage from the audience is go direct, go talk directly to Barbara, Laura, Mitch and Bonnie Jean, and see how your variations could work in this broader scheme of dynamic pension pools. But what I want to do for the last few minutes is actually pull it back up, and first a question for Mitch, as in where to from here, as in how do we make this real?
How do we make it real? Oh, let's go back to what I was saying earlier. And
what's your wish list?
The big wish list. Governments step in, and especially the federal government as a starting point to basically dismantle all the barriers that especially on the tax side. Personally, that would be the first set, and then there are some governance related issues. And then after that, to have that people who are interested and like-minded, promote this product, because, we can certainly make it all work. And I'm the ever the optimist, and we've got a smart group of people all working together on this, and a very broad group, as Bonnie Jean, showed that letter that sort of initiated these initial discussions a few years ago. We've got a great product. And so I'm confident that this will work. After that, the part is the marketing and the take up. So my wish list is more on that end of that people actually understand, when this, finally works, hopefully sooner than later, what a gift they're getting, and how important retirement savings is. And people tend to forget about these issues until it's never too late. But the earlier you get on this, and the earlier you start to save, and the earlier you realize that the financial part ties in very well with the health part and the healthy living and the entire aging process, the better life you'll lead. I mean, we work for X number of years, and then we're retired for many more years, and we need to plan properly in order to be able to enjoy those years and to have the best life possible. So in short, Bruce, federal government, please step up. Other government jurisdictions, help when we bring this forward to you, and general public out there, understand what all the hard work that is being done on your behalf to help you save. So step up when an opportunity is presented to you.
And now we're moving to the top of the hour. I want to give here's some closing comments. The final comments will come from Bonnie Jean, as in, what's your wish list from us?
Yeah, so the wish list is basically, this is already becoming a reality. And the question is just how good of a reality is this going to be? And I think what would be, really disappointing is that the barriers that we've identified are just so restrictive that what could have been a really important solution for an aging population. We don't want to talk about what's been happening these past few years in nursing homes. We've gotten this very vivid reminder of what it looks like to be vulnerable and old and not have financial security. This is all one big picture. This is not just about having money when you're 65 and taking a vacation. This is about creating better tools in the Canadian retirement income system to protect our entire elderly population. And that will also, of course, protect our younger populations who are basically being left responsible to care for the elderly population and our entire economy. So in my view, this goes much bigger than just kind of another financial product. This is basically, we are in a situation now where we have this, massive, a quarter of our population is moving into retirement. They have the health and the wealth right now to make good decisions. Let's give them tools to make decisions that's going to not only protect their financial well-being for the rest of their life, it's also going to protect all of us. So that's my wish list, is really to get that message out there, to really urge government to understand this has very long-term consequences if we do not move quickly.
Yeah, well, a powerful way to finish up. So Laura, Barbara, Mitch, Bonnie Jean, thank you very much for today. I would like to thank all our speakers out for their time and wish everyone the great rest of your day.